Hi, Yassine from Change Wealth here to talk to you today about what is a mutual fund. It's a term that many of us will hear pretty often, but today we're going to talk about what we actually mean when we're talking about a mutual fund. So very simply, we'll make the point by way of an example. So suppose we had a series of financial instruments. Let's say there's 5 kind of stocks or bonds. Of course, in the market there are a lot more, but let's say we're focused on 5, and investor A wants to own a piece of each of those 5 securities or financial instruments. Now, if investor A was to go out and try to buy those things on the open market, there's a couple of barriers to that, I guess. Number one is the unit price of each of those financial instruments might be sort of prohibitive. So if each of these, cost, this one's 20 bucks, this one's 100 bucks, whatever, it may be cost prohibitive for investor A to own a piece of all of those different financial instruments. Plus the cost of acquiring each of those financial instruments may be high as well, so there's transaction costs and that kind of thing. Instead, there are these companies that come along, mutual fund companies, and they'll go and they'll buy a bunch of units of these 5 different instruments, and again, 5 could be hundreds kind of thing. This is just a simple example. So the mutual fund company comes along and it basically combines units of all 5 of those financial instruments into like a big, well, it's the fund, is what it is, right? Now the fund is a big pot which has a mix of all of these different financial instruments, and the mutual fund company, this basket of securities is the mutual fund. From there, that basket of securities will be carved up into little units, and that's actually the word that's used. So a unit of a mutual fund will have a price reflecting the underlying value of all the things that are in it, and then units of that fund can be sold to different investors. So investor A, B, C can each own units of the mutual fund, which will have a mix of, say, these 5 financial instruments in them, right? So mutual funds are a way for individual investors to own small pieces of a large number of different financial instruments. Why would an investor want that? Well, having a mix of investments in your portfolio is advantageous from a risk management perspective. So take the simple example of, like, you want to own one company. Let's say you want to own an oil company, and on the other hand you have a transportation company. Now think about what would happen to the value of those stocks depending on what happens with gas prices, for instance. So the oil company may become more valuable if gas prices goes up, but the transportation company may become less valuable. So by owning a mix of securities in this way, you can actually own things that offset in value depending on what happens in the environment, the investing environment, I guess. And so the idea of owning a collection of securities is really about managing risk. And mutual funds allow investors that opportunity at sort of low cost in a way that they couldn't replicate by themselves. The word mutual, of course, comes from the fact that this collection of securities, this basket of stocks and bonds, for example, is mutually owned by a whole bunch of investors. And if we take this simple example and we expand it to include, hundreds of securities, stocks, bonds, that kind of thing, and, possibly thousands of investors, that's more like what happens in reality. Hopefully this was helpful, and we will talk to you again next time. Thanks.